All right, we're live and welcome to Real Talk on Real Estate. I want to talk to you guys today a little bit about what's happening in the mortgage industry and leverage, interest rates, and all of the above. Okay, so one of the big things, guys, is that right now people are looking at the Feds proposing to cut interest rates. And they did one interest rate reduction. We have a Fed meeting that's coming up that we believe we're going to have another rate reduction, which is good. But let me talk to you about the caveat of really what's happening on the back end with the 10-year Treasury yields and how they affect lending, investors, and real estate. Because most people never stop to think about this stuff, nor do they even know because it isn't really taught. And so it's my job to enlighten those of you who are investors and taking a look at the current state of the market, thinking, interest rates were high. They're starting to come back down. It's time to purchase. But when you go to the bank and with what you hear on mainstream television and all the major news stations, you sit back getting excited going, interest rates are going down. I better hurry up and hustle, buy me some real estate before they get too low. And there's so much competition and blood on the street that I can't make any more good acquisitions and good deals. And the real truth of that story is the elections could have an exact correlation to how lending takes place over the next few months. Now, let's take a look at both sides here, non-biasedly, okay? And let's just talk about the reality of what really happens with 10-year Treasury bonds, how they affect interest rates and so forth, okay? And let's take a look at what the proposals are and how this is going to affect you guys long-term, okay? Now, typically, when 10-year Treasury yields go up, mortgages go up, okay? Because theoretically, interest rates, when the 10-year Treasury yield goes up, mortgage rates typically go down, okay? But what ends up happening and what's happening right now is that the 10-year Treasury yields are going up. Interest rates did come down a little bit. We're proposing for them to go down a little bit. So that's happening. But what they fail to tell you is that the price of a Treasury bond, when it goes up, its yield goes down, okay? When bond prices go down, the yield goes back up, okay? And so leverage typically decreases. And some people might sit back and go, Jerome, what is leverage? And leverage is the percentage of money a bank will lend you on your asset based on its value. So you guys have all heard the term, the banks will lend you 80% loan to value or 70% loan to value. Right now, you're hearing 60% loan to value. Shit, we've even heard as low as 52% loan to value, which is what we're getting from some banks right now on our stabilized assets, which is mind-blowing. And the reason why, as 10-year Treasury yields go up, leverage goes down and its yield drops, okay? And so the reason now that we're hearing, instead of hearing 80% loan to value or 80% loan to cost on new construction, we're starting to see 52% loan to values, 60% loan to values. And it's overwhelming because the leverage that we once had no longer exists so long as the 10-year Treasury yield is up, okay? Now, what's happening right now, let's take a look at the reason for lower lending rates, and let's look at what happens, okay? So Treasury bonds, when they go up, it equals to the attractive price of, so let me put this in a way. I don't want to get this so complicated that I confuse everybody, okay? So let me put it in more layman terms, okay? So as Treasury bonds go up, the Treasury yield, Treasury bonds, are when the government goes out and they print these bonds for public acquisitions, right? So people buy these bonds. Let's say it's for a bridge or for a diversion channel or for roadways or for infrastructure or for airport development, or whatever those bonds are for, okay? Maybe it's for flood mitigation, whatever it's for. A lot of that stuff, maybe it's to fund wars and bombs and airplanes and so forth and so on. Whatever those bonds are, as they go up, the yield, as the bond goes up, and the more money they're going to pay out to you as an investor, you sit back and go, wow, well, typically government-backed Treasury bonds are very safe. So I can go in and I can buy, $1,000, $5,000, $100,000 in these Treasury bonds, and I can realistically see a 4%, 5%, 6% return on these Treasury bonds, okay, which is very low risk for the vast majority of people. So when this happens, it puts a downward pressure on lending rates because investors become less inclined to lending money. So you're doing well, you have money, and multifamily, real estate, and all the other sectors around you seem to be collapsing one wall at a time, right? Syndication companies are going out of business. One wall's collapsing, another wall's collapsing. These 5-1 arms, 3-1 arms that syndicators got on assets are now coming due, and they're maturing. And when they mature, they become on a volatile, fluctuating rate mortgage, right? So it's on an adjustable rate. And when it becomes adjustable rate and interest rates are high, you go from a low basis to a higher interest rate. Your debt service goes up exponentially, and now you can't afford the asset, okay? So now lenders and investors both are sitting back going, we can't lend you on that because cap rates are going up, values are going down, and because values are going down, what that asset was once worth, now it's not worth that anymore. And so all of a sudden, leverage goes down, lending goes down. Now we're sitting back, we're waiting for the Treasury yields to drop back down because people are now putting their money instead into syndications. They're putting it into Treasury bonds, and they're sitting back going, I'd rather take a low risk 4%, 5% return on my money than a high risk 10%, 12% on my money, not knowing that the general partner of that investment really knows what the shit they're doing. And P.S., by the way, as much as some of them did know what they were doing, market circumstances would otherwise show differently, meaning that they didn't know what the fuck they were doing, okay? Plain and simple, they didn't know what they were doing, or they wouldn't be in that position. Same thing that happened when I went after the market in 2016. So we started buying multifamily, and when I did that, I saw the writing on the wall. We saw 8% cap rates, guys, 8% returns on investments. And when the cap rates are high, values are modest. They stay low, okay? Now, cap rates started to get compressed down to a 7%, then down to a 6% in just 2 years. And I thought, well, shoot, how can the market sustain this? It can't. There's going to be some downward pressure that comes in some place that's going to otherwise compromise investments. And no broker would admit to it. No investor would admit to it. And lo and behold, I had no idea it was going to last another 5-6 years before the market tanked. And so I sat back and said, it's crazy. Like, the market's crazy. I'm going to build these assets at like a 15% cap rate. Because if I do that, now I have less downward pressure. The reason, ding, 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 that we've been so successful under this market compression. And so what I'm telling you guys is you can follow my business model. And for those of you guys who can't, just understand, ladies and gentlemen, that with interest rates going down, and as attractive as the media makes it sound, we're living in this heyday, right? Woo, yay, interest rates going down. The reality sets in. And the real reality is that with the 10-year, with yields going up, even though interest rates are going down, leverage sucks. Banks aren't lending money. Investors are less inclined to lend money at higher interest rates, putting downward pressure on lending rates across the market, guys, because private money is also lent not just to you and I as syndicators and investors, but now JP Morgan, Chase, Citibank, Merrill Lynch, all these guys now raise private debt. They themselves take your money as an investor, and they themselves are raising private debt through a private equity fund that now gets lent out to investors, guys, and into real estate projects. And so they're taking private capital because it's traditionally less expensive. But now all of a sudden, because Treasury yields go up, the average investor is not as attracted to, even when institutional debt is being raised for equity on these big investments. Now they're sitting back going, why would I invest there with a little bit higher risk when I can invest with lower risk and get almost a near shy of a guaranteed return? And so when you take a look at the way the presidential election is going this year, you're going to have to take a look at it like a grain of salt, right? So non-biased, I told you guys I'd come in non-biasedly, and although I'm 100% biased as to who I feel should win, we should know that there's going to be an exact correlation to leverage, the 10-year Treasury yield, and overall interest rates, and how those all work together in reference to leverage, lending, and the success of long-term investors deploying their money into private sector real estate, guys, private sector real estate, you and I, okay? And so it's become less attractive over the last several months for private investors to invest in syndication companies and firms like your firm and my firm as individuals than it is to just go to U.S. Treasury bonds and invest there because of the safety net that they have there, in spite of the return on investment being substantially lower. So ante up all of what I'm saying here and understand that business and business owners themselves are the only ones that can strategically position themselves to make minor adjustments to this until the Federal Reserve themselves make an adjustment and the market settles. Hence, Treasury yields go back down, find a balance. Interest rates also go back down a little bit. We find a balance, and then the market will slowly start to rekindle strength from investors, lenders, leverage, all of the above. Ladies and gentlemen, if you guys want more educational content just like this, click and subscribe to our YouTube channel, smash that thumbs up button, and comment below your thoughts on the topic that we're talking about: 10-year Treasury yields and bonds, leverage, interest rates, investments, real estate. And I look forward to seeing you guys next time. Good night. God bless.